The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
And welcome to Your Money, Your Call, bonds versus equities. Today we'll be focusing on the great rotation. Stay tuned, we've got some great questions. We've got a great show for you tonight. I have Chris Joy. He is here for us as a guest. He is a columnist with the Australian Financial Review, and he's also he's a director of Yellow Brick Road. I have Roger Montgomery, who is here from Montgomery Invest. Welcome, gentlemen. How are you? If you care to be part of the show, please call us on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au. And as I said, I'm Mark Todd from FIIG Securities. Welcome, guys. How are you?
Good, thanks.
I wanted to start with the theme that this great rotation. When I was on holidays, I came back, and all of a sudden there's been an event. Everyone's moved out of cash. They've forgotten all about the bad news of the equity markets, and they're all rolling into it. And I suppose, if I can start with you, Roger, the idea of the great rotation. And I don't know if I'm paraphrasing PIMCO. I don't know whether they came up with the term. I know that when they came up with the new normal, everyone used it. So I don't want to, I'm not making a disclaimer, but it might have been them. The great rotation, is it real? What do you think it is?
Okay.
And how do you think the investors should consider it? What's actually happening?
And here's an interesting one, and I'm sure you're going to wish that I hadn't said this right at the top of the show.
Right.
But I think there hasn't been a great rotation at all. No one left equities to begin with.
Right.
And in fact, when you look at the stats, most of the stats, and the PIMCO side of these stats as well, when you look at data and the level of funds in mutual funds in the United States, you see that there's been a substantial decline. There's been outflows from mutual funds in US equity funds. But to compensate that, and what nobody's citing, is the fact that there's been a compensating increase in ETFs, exchange-traded funds.
Ah.
So money's coming out of equity mutual funds and it's going into ETFs. So on a net basis, there actually hasn't been an exit from equity funds. Having said that, though, the proportion invested in equities versus bonds has been shifting overall, but it hasn't been as dramatic as it looks when you just look at the mutual fund outflows.
Right. But when you talk about it, there's a real theme about it, isn't it, Chris? Like, everyone is talking about it. I look up Market Watch, I look at all the different Bloomberg, and it's got value in the commentary. Now, is it just part of the commentary?
I think actually the original great rotation was out of equities and risk asset classes like housing into cash and defensive asset classes. Yeah, to a lesser extent bonds, and that's prevailed for several years. And I think we're seeing a very significant change in sentiment and risk appetite. That's in part a function of the very strong returns that are now coming out of those risk asset classes, but it's also an artefact of policy making. And the fact of the matter is central banks around the world have floored interest rates, so they're actively encouraging investors and savers to go and search for yield, and that's why we're seeing these so-called growth asset classes experience high demand.
I mean, I was reading the PIMCO outlook, Bill Gross's outlook for February.
And just remember this, though, Mark. He doesn't always get it right.
No.
Everyone reads it and everyone listens to it, but they've been calling. There's been a call about. Sorry to cut across you, but there's been a call for a bond crash since 2009 every single year. So that's 5 years in a row.
Correct.
In January every year they've called a bond crash, and it hasn't happened. And now, this could be the year it does.
That's right. But he did the mea culpa, and he said, I didn't get Treasuries right. He admitted that he then had to go long, and he changed his view. So, but he does move policy. He does talk, and people do listen. So he does affect what people are saying. And I think the point that he was making in the recent outlook was his concerns about the debt markets in general. His concern was around the fact that, and it's more the US, his concern was around the fact that you had to put so much into the US now in debt to get any movement in GDP, so you're flogging that horse and you have to hit it harder and harder with the form of debt. And so his perspective was, we aren't getting the risk rewards that we should get for the amount of debt. I mean, what do you think about the idea that we're not getting the bang for our bucks, and to Chris's point, we're going into other assets to try and get that?
I think there's been a bubble in cash, but that's a reflection not of the fact that the returns are attractive, but a reflection of the fact that everyone was scared of every other asset. So whether it was commodities or currencies or hard assets or equities, people were afraid to invest in anything other than cash. So even though they were getting negative real returns, they were happy to stick their money under the bed, so to speak, and shove it into the mattress. That will change, and this year is probably the year that that'll start to shift.
I'll argue a little bit against this, because you would remember with the term deposits in 2007, some of the rates you could get, Suncorp were paying 10%. Some of these things have 5-year debt.
Yeah, I'd actually probably disagree with Roger. Cash, if you look at the RBA cash rate over the last 20 years, if you can get 1% above the RBA cash rate, you've got a real return after core inflation of about 4% per annum. That's above your cost of living. So I think people are actually getting very, very good real returns from cash over the last few years. And it was the fusion of a huge increase in risk aversion, a flight to safety and security, which obviously drove us all into deposits and to a lesser extent bonds.
Bed mattresses.
But the fact of the matter is, I agree with Roger. Today, the RBA, I don't agree with these policy-making decisions, but the RBA has floored the cash rate. We have the lowest cash rate in history. There's a risk it goes lower. And real returns to a lot of deposit-taking accounts today are near zero or negative. I think the average online savings account rate is about 3%, so it's 50 basis points above the core inflation rate.
And think about treasuries. You know, treasuries are yielding 2/5 of zero. And
very politely put there.
Thank you very much. I realise I'm not at home. I'm
clearly
on TV.
Clearly not.
But the reality is, people think treasuries are safe. What could be riskier than being guaranteed to lose purchasing power? You know, there's nothing that's more risky. You're 100% guaranteed to lose purchasing power.
But I think there's actually a much greater risk than the loss of purchasing power, and that is the mark-to-market risk associated with fixed-rate bonds.
Absolutely.
And I talked about this late last year, and for viewers who don't understand, this is basically the notion that with a fixed-rate bond where you have a set coupon, if outside interest rates increase and you try and sell that bond, it's going to be worth less in your hands. And I think the anomaly here is that global interest rates are at near 200-year lows. And so on the balance of probabilities, with the global economy looking like it's going to be performing better, there is a risk we see higher interest rates, and that's good for floating rate notes and it's good for cash, but it's not good for fixed rate bonds.
We've had an email. It's from Timothy. Writes, as an active investor, is inflation something I should be concerned about? Can we start with you on the inflation concern?
Firstly, I think I don't know a single thing that I have bought that has gone up 3 or 4%.
Right.
Everything I buy goes up much more than that, and the only reason the official rate of inflation is low is because it includes things that we don't buy as frequently. So you get deflation in electronic goods, you get deflation in TVs, and laptops and all that sort of stuff, but you buy those once every 3 years. Right? The stuff that you're buying every day and the stuff you're buying every year seems to go up by more. Now, that might not be true for somebody who has 3 children. That might not be true for somebody who's retired or somebody who's, you know, on holidays around the world. But for me, my inflation rate is much higher. So I think inflation does matter, and the whole point of investing, is to lay down some dollars today in the expectation that you're going to get more dollars than what you laid down in the future. And the more dollars you can get, the better. And the reality is that if we go to a restaurant today, there's a certain restaurant that we can afford to go to. The fear is that inflation means that in 5 or 10 years' time we can no longer afford to go to that restaurant. So we've got to preserve our purchasing power. And I think, and if you're travelling internationally, if you think that when you retire you're going to be going overseas, you've got to preserve your purchasing power globally. So that means thinking about the currency as well. So I think inflation is important. My whole job is to beat inflation for our investors and make sure that their standard of living goes up rather than being maintained or going down.
Absolutely. And would you agree to this? Or
yeah, I agree with everything Roger just said, and I'd only add that policymakers around the world today are all desperately trying to stoke inflation, perhaps with the exception of a few countries like Australia. So there are very significant risks to the upside associated with inflation outbreaks, and the concern I have is that for 20 years we've had central banks who have quite vigilantly anchored long-term inflation expectations and maintained relatively stable prices, and we're seeing the politicisation of policymakers and central banks. We're seeing central banks around the world print money in order to buy government debt and reduce the cost of that debt, and they seem to be loosening their grip on this commitment to low inflation. So there is a risk we get much higher inflation in the future.
I mean, clearly the GFC, you saw the politicisation at its worst. You know, you saw Bernanke come out trying to conduct policy. You said Paulson. Everyone was trying to conduct policy, and everyone had an opinion. And in days gone by, they would have kept their opinion behind a closed door and said, you know, what do you think here in the event that that's the wrong decision? What could we do? That doesn't happen anymore. Right now, everyone is out. You know, Mr. Swan, will be out there really driving in code to Mr. Stevens, doesn't he? It's unrelenting at the moment.
We're actually seeing, which I think is somewhat unprecedented, board members of the Reserve Bank of Australia who previously wouldn't make any comments that were perceived to conflict with the RBA's goals, actively jawboning the central bank. So we had, I think, Heather Ridout in January saying that the economy this year is going to experience an air pocket and will require active management. Now, if you want low interest rates, that's good. But if you're a retiree or a saver who's worried about the cost of living and wants to keep that cost of living down and earn high real returns, and that really means positive returns above your cost of living, then you want the RBA to be doing its job.
And would you agree, is that the sort of thing you'd be looking for, that the RBA and the board members to be a little bit more reticent and not being as public in what they do?
Look, I actually don't believe that that's going to ultimately make any difference at all long term. I think it affects short-term movements in markets, but over time, markets will move with valuations, and interest rates act like gravity. So the higher interest rates go, and we were talking a moment ago about the inverse relationship between bond prices and bond yields, but the reality is that that's true of every asset. Property's the same, shares are the same, business valuations are exactly the same. The higher interest rates go, the lower those valuations, and I think long term, prices follow value. So it won't have an impact short term. It won't have an impact long term.
Right. Going back to my original premise about having this great rotation theme, two things I'd want to bring to your attention. One is, when I was talking about the term deposit rates, if you can get 10% from a Suncorp on a term deposit rate 5 years ago, a lot of people put a lot of money into those term deposits, which of course are now coming due.
Sure.
And so they're now reinvesting at 4%.
And 5 years ago it was Westpac, Westpac term deposits.
Westpac term deposits.
5%.
The rates that they were doing. And so the idea that the banks are trying to recalibrate expectations for the person who's buying a term deposit, you should expect a lot lower rate. You used to be able to arbitrage different branches of the one bank. That doesn't happen anymore, so that's all gone. So rates are much lower for a deposit holder, having come off at 10% into a 5%. And I feel that the professional money managers sort of could see that happening, and that's where you started to see that rally in the banks and started to see that rally in Telstra. I mean, am I getting that completely wrong? It's just that combination.
No, you're absolutely right.
The deposit market maturing and fund managers saying, well, hello, they'll need dividends.
Well, we've seen a big uptick in inflows in our business, and that's a result of people coming back from holidays. Their term deposits have matured, they've looked at what they can get, and they've said, forget that, I'm not... It used to be the case that if you saved $1 million, you were rich.
Yeah.
And now you've got $1 million, you've worked hard your whole life, you put it in a term deposit, you're going to earn $35,000 or $40,000 a year. That doesn't seem very rich. And so people are looking for higher yields.
And purchasing power at $35,000, $40,000, I mean, I love my wife dearly, but that just isn't going to help her. I mean, it's not a lot.
Yeah, and I think it is interesting that we're seeing the banks now place greater pressure on their deposit rates, because ultimately they're worried about those net interest margins, which is the difference between their lending rates and their deposit rates. And for the last 5 years, one of the reasons people have got really good deposit rates is the banks were under pressure to increase their share of deposit funding up to about 60%. Yep. So they were paying over the odds for their deposits to attract those customers. But they've done that job now, and we're really seeing those savings rates get crushed. The RBA claims it's not worried about that because it's incenting people to go out and, again, hunt for yield, spend money, take on risk. We're seeing, I mean, within the Yellow Brick Roads business, notwithstanding we offer cash and fixed income products, we're seeing a big increase in demand and very strong inflows because people aren't getting the returns they require to survive from traditional deposit-taking products.
Correct. OK, we'll be going to a break, but before we do that, we're going to have a time to crank up a new speed round clock. So, Chris, you're going to start. You've got 30 seconds. And what we'd like to hear is the end-of-year rates on cash, the dollar, all odds, and equity markets. Sorry, and bond markets.
Sure, yeah, no problem. So I expect the cash rate to be within plus or minus 25 basis points of its current level by the end of the year, so not too far away. I think the all odds will be around 5,250 to 5,500 points. I think long-term bond yields will be 100 basis points higher. And I think the currency will be around parity. I think the currency could actually face pressure because of risk-on influences counterintuitively. That's it.
That's fantastic. You've done it in time. Thanks.
The Volvolution sale is back with free registration, free CTP and free stamp duty. Plus 3 years or 100,000 kilometres free scheduled servicing. You'll also receive 3 years warranty and 3 years roadside assistance. That adds up to over $5,000 worth of value. Hurry. Sale ends 15th of February.
Fortunate Frank is the luckiest traveller on earth. He doesn't need travel insurance. But you might, because when you travel, a lot of things can happen that are beyond your control. Virgin Travel Insurance provides cover from 96 cents per day, including lost luggage, cancelled flights, overseas medical and emergencies. Visit virginmoney.com.au or call 1-800 034 264.
Want to know the best kept secret for amazing deals? Then visit Quibbits.com, where thousands of customers save up to 95% on products like tablets, HD TVs, cameras, appliances, and more. Imagine getting a new Apple iPad today for just $33.93 or a Samsung 50-inch TV for as little as $61.43. At Quibbits, we do things a little differently. Auctions start at $0, and each bid raises the price by just 1 cent. The result? Insanely low prices. On Quibbits, you can save up to 95% off. And even if you don't win, you'll never pay more than retail. You can't lose.
I'm Brian, and I've won over 30 products and saved over $7,000 on Quibbits.com, the best place to get amazing deals online.
Stop everything and visit Quibbits.com. That's Quibbits.com. Go to Quibbits.com now.
I see Newsnight as about connecting the dots, about saying that what happens overseas matters to us here. It's not something we're remote from. What I want to do is to say what I feel in Australia is the same as what someone may feel in China or someone in Israel. That what we share is greater often than what divides us. The only way you can do that is to understand each other. Hopefully at Newsnight we can open a door. The world matters. Our role in it matters. That's what I want to bring here at Newsnight. Then I will have done my job.
Welcome back to Your Money, Your Call. My name is Mark Todd from FIIG Securities, and tonight I'm joined by Chris Joy, who is a columnist with the Australian Financial Review and a director of Yellow Brick Road, and of course our equities expert Roger Montgomery from the Montgomery Fund. They're here to answer your questions, so please pick up the phone and call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. And we've got a caller right now, Chris from Melbourne. Hello, Chris.
Hi, guys. I'm just ringing up about the bonds held by QBE. Everyone talks about them being hostage to the bond market and the low interest rates they're getting at the moment. Are they able to just, dump them all at once, or do they have to wait till some sort of maturity and then they'll lose a whole lot of money as the bonds come down and as the interest rates go up?
Do you want to answer that one, or I've got a view on that one?
You can go first.
QBE's been very conservative. What they do is they take the premium, so they look to insure people, and it's the classic story with an insurance company. You're effectively taking on a liability that you might have to pay out, but in advance of that, you look to make an investment. So you look to make, Buffett calls it the sweep that you'd like to make, or the cash flow that you'd like to make. QBE being very conservative by short-dated US Treasuries. And the problem for that was that that curve is zero.
They're also required to. Under the legislation, they have to, and it has to be kept in the country where they're providing the insurance.
Correct.
So that's why. The big issue, of course, is that, the benefit for them is if interest rates start going up.
Yeah.
And so they've been suffering, and if you look at the intrinsic value, as well as the price of QBE over the last 7 years, it's been declining steadily. And the reason that's been the case is we've had this ZERP situation in the US, so they haven't been generating any returns on their bonds. That will change. It will change dramatically. When it does change, you'll also see the Aussie dollar come off against the US dollar, so they'll get the benefit of the transfer back to Australian dollars, and their profits can go through the roof very quickly. But people have been calling it every year.
That's right.
And it hasn't happened.
And one of the things that they continue to do is expand into the United States. And if you're in the United States, the insurance world is quite different from the rest of the world in that it's regulated by a state base. So it's a pyramid system. So the states dominate. I need to be compliant with the state legislation, and then I go to the federal. So when AIG went under, you'd go to AIG Insurance and said, give me all that money. Well, they said, you've got to go to the New York Fed. You've got to go to the New York insurer to approve the movement of the transfer of this money, because the greatest concern from all these regulators is no one will pay out a life insurance policy. So QBE is the same. They need to be compliant with whatever US domicile they're working with, whatever state. And so that means buy short-dated bonds because they're very safe. In the perspective of the US is that they're very safe, and so therefore the returns are weak. So you're right.
They're unique in the sense that they don't invest in equities. It's only in short-dated bonds.
That's right.
So
the safe haven.
Yeah, and that's really helped them. You know, that's really when around them a lot of insurance companies go bust.
Yeah.
As a result of catastrophes, they've done very, very well. So people think they haven't, of course, because they look at the share price and it's been diabolical. But eventually the cycle will change, and the premium cycle will change as well, and premiums will start going up as there's less competition.
Yep. I hope that helped, Chris. What we'll do now is we'll start to go to we've got a screenshot of some fixed income and some debt. Before we start talking about this, I'll make a point of thanking Stephen Nash from FIIG. Dr. Stephen Nash is head of strategy there, and he's great with some of these charts. And it's not always easy to understand when you look at a whole bunch of lines the effect it has. But the top line is it is the Sydney Airport inflation-linked bond maturing in 2030. And if you can see the performance, that's performed somewhere between 20 and 15%. And this is the bond market. It's not supposed to do that. And what he's done is he's compared that with the All Ords and the performance of the All Ords. So it starts at -10 and it's moved its way up. And I think
what we should talk about is that's the rolling annual return.
Correct, that's the rolling annual return. So in other words, what will happen is as a bad year rolls off, the performance improves. But the thing to look at with the inflation-linked bond is twofold. One, it's a senior debt. So you can see that in the bond market, there's not the same sort of volatility. Now, Roger, you would say there's not the same sort of opportunity, but a percentage of your portfolio, if you have that thing in your portfolio and you've got an inflation-linked asset that's producing, I think it started at 5% over CPI. So if inflation's at 2.5%, this becomes 7.5%. That becomes quite an attractive return.
Yeah, sure. I think you know, those sorts of double-digit returns from bonds are unusual and probably the exception rather than the rule. But having said that, I think the chart's very interesting because it highlights the differences associated with the asset classes. So as you mentioned, that first period, the lower line, the All Ordinaries is delivering negative rolling annual returns. So that really, I think, conveys the risk associated with equities, the fact that you do have probabilities of loss, but now we're seeing very, very high returns.
Yep.
The other point about Sydney Airport, of course, is it's a BBB rated issuer, so it's one notch above investment grade, so you are carrying some credit risk there. I think Sydney Airport's probably also benefited in the last months from a significant reduction in perceived credit risk, which has actually furnished holders of debt securities capital gains. But going forward, yeah, I mean, it's an open question what will happen.
The other thing is, it appears, if you look at the horizontal axis on that chart, you only look at 1 year. You know, it's January to January.
Yeah, you just, all we did was look at the 1 year. I think you can make these much more convoluted. You know, I think the performance of that bond has been quite interesting in that a lot of the institutional sellers have started to bring that to the market, and now more people are becoming aware of inflation-linked assets, so they started to buy that. And that's what generated some of the returns and some of the positive features of it. Otherwise, it might have just sat in bond portfolios that no one's actually listening to and seeing.
And one of the unique things I think about inflation-linked bonds is they are one of the few pure inflation hedges. Everyone talks about covering their cost of living, but it's actually very, very hard to do. And a lot of the inflation hedges that do exist come with very, very high risk.
And Chris, the reason why it's hard to cover your cost of living is because as you earn more, you spend more.
That's true.
People are aspirational. They always want more than they've got.
And I think we had did we have the chart of the equity there for the Sydney Airport? I mean, I think that's one of the things you'd like to try and consider. Do I buy... Okay, so there's the chart of the actual underlying equity. So do I buy the equity or do I buy the debt? Or, you know, I would offer the thoughts that if you like Sydney Airport, it is a bit monopoly. If you like the monopoly trading strategy, you might look to say, let's have part of both. Let's have a little bit of the equity or a little bit of the and the debt. And it might give... The thing that was very obvious to me was just the volatility in the performance. It's up and down, it's up and down. And that's a real concern for an investor that might be watching this show. Professionals might be different.
Yeah, no, well, your point's made. I'm just concerned that chart was such a microscopic view. You know, it was 1 year rolling annual returns, and you know, had we gone back 5 years or 10 years, a very different picture might have transpired. Having said that, though, when you're buying equities, you need to do something that most people don't do. What typically happens is people treat the stock market as a place to trade stocks, and so they tend to buy stocks and betting that they'll go up in price. And that's the same as betting on black or red at the casino. You need to approach stocks as if you're buying businesses. And if you buy a great business, you're going to make a lot more money over time than, I think, than buying bonds, particularly at this time of the cycle.
We can talk about that, but we've got Carl from Melbourne on the phone. So,
no
Carl, can you feel free to chat?
Hi, Mark, and thanks to you and the panel for taking my call. I'd like to ask two questions. One, a very quick and very naive question, because I'm fairly new to bonds, and one about strategy, I guess. First question, when a bond is coming up to a date when it can be called, is the price paid on the call date the face value, or is it the current capital value of that bond? And my second question is in relation to inflation-linked bonds. I'm invested mainly in the equity market. I'm coming up to retirement age. I'm transitioning into bonds for some of my investment. Should I be looking at inflation-linked bonds at this point? I read a lot about the potential for there to be a bit of a bond bubble at the moment, and that inflation could be coming up. How should that be viewed? What should be the strategy of looking at the merits of fixed income bonds and inflation-linked bonds?
Great questions, Carl.
I missed the first question because the volume was too loud and it was all distorted. But can I talk about the second part?
Sure.
It's an excellent question. Baby boomers now are moving towards retirement. The biggest bulge that we've seen in Australia's history in terms of the population, the cohort, are now retiring. The big issue is that the most common advice that they receive is when you retire, you need income, so therefore switch out of equities and growth assets and go into income assets, so typically bonds. The problem with that, of course, is that it is inflation. And so if you're on a fixed rate, and I'm not talking about floating rate notes here, but if you're on a fixed rate of income, then it's very likely that within 10 to 15 years, and you will live more than likely 20 to 30 years after you retire, 10 to 15 years, your purchasing power's gone. And so you need to have that growth even when you've retired. And a lot of advice that's going around is that you don't. You need safety and you need income. And I think there needs to be a balance in that advice.
Yeah, I agree with that partially. I'd only say that bonds aren't just about fixed-rate bonds. You have floating-rate bonds. Which
that's what I said, with the exception of floating-rate bonds. I understand, and floating-rate bonds are a great inflation hedge because we have a central bank that targets inflation with the cash rate. Cash is actually, as I mentioned earlier before, a good inflation hedge, and inflation-linked bonds are obviously purpose-built for that requirement.
So in terms of Carl's first question about bonds being called, they get called at $100, they get called at what's called par. And in terms of the strategy around as a retiree, what you should do, I think it's a combination of both. It's clearly a combination of both. It's a question of trying to find the right advisor or taking it upon yourself to be the investor and then saying, I don't know what's going to happen. That's clearly, no one knows what's going to happen. So in the event I don't know, it's Rumsfeld. I should trade as if I'm Rumsfeld. So I should have a little bit of floating, I'll have a little bit of fixed because I can live off 6%. If I get 6% fixed, I'll live off that. A little bit of inflation, and then I'll look at the equity market and I'll find something that I'm quite comfortable with, whether it be 5 stocks, whatever it might be. But I really don't need to go and have a coffee with a friend and say, buy this penny dreadful because it's going to jump. So I need to migrate my strategy around expectations.
I just warn investors about fixed interest, just vanilla treasury, government bonds. Because if we all nodded off today and woke up in 10 to 15 years' time, my very, I think arguable guess, and I think it is a guess, but I reckon we'll wake up and interest rates will be significantly higher than where they are today. If you go back 100 years, you'll see there's a definite cycle in these things. And we're at a low. and the next 10 or 15 years, we wake up, we'll see interest rates a lot higher. So you have to be very, very careful.
I absolutely agree, but I think you've got to start talking about the diversity of the bond market as being not just the government bond.
Yeah, and that's important.
If
that's why I
somebody's buying a bond,
government bonds.
That's a problem.
And also the flip side of the equity coin is obviously that you're exposed to annual volatility. All odds accumulation index over the last, I think, 25 years, you're looking at 19-20% per annum volatility. So you have huge probabilities of loss. So just to remind viewers, in 87 you lost 44%, in 2001 global equities you lost 50%, and then in 2007, 8, 9 you lost 50% again. So
that's exactly why you need a sensible
It's a great conversation. It's a great conversation, but we must go to a break. Please feel free to give us a call on 1300 30 34 35, or any questions you might email us. It's yourmoney@skynews.com.au. We'll be right back.
When it comes to a freight partner, size and innovation matter. Our huge network and 3,000 vehicles guarantee fast, reliable delivery across Australia. We're proud of our history and our growth. It's a tribute to our people and their dedication to customers, providing fresh logistics solutions and new ideas like auto-sort technology, supported by a service-first commitment and total care for every package. Bigger, better, faster. Star Trek, when service matters.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, Australia's #1 Forex provider.
Holden's 2012 plate clearance is on right now. Drive away the 2012 plated Captiva 7LX and get everything you really want in an SUV, like 7 seats, an electric sunroof and side steps, plus Bluetooth phone and audio, and 19-inch alloys. There's also a touchscreen sat-nav, rear-view camera, front and rear park assist, and heated leather-appointed seats. Now you get all that from just $39,990 while stocks last. We're clearing all 2012 plated Holdens. For savings you don't want to miss, hurry into your Holden dealer today.
Want to know the best kept secret for amazing deals? Then visit Quibbits.com, where thousands of customers save up to 95% on products like tablets, HD TVs, cameras, appliances, and more. At Quibbits, we do things a little differently. Our auctions start at $0, and each bid raises the price by as little as 1 cent. And even if you don't win, you'll never pay more than retail. You can't lose. That's QUIBIDS.com. Go to Quibbits.com now.
Welcome back to Your Money, Your Call. My name is Mark Todd, and on the panel tonight we have Chris Joy, who is a columnist with the AFR and a director of Yellow Brick Road, and we have Roger Montgomery from the Montgomery Fund. Gentlemen, we have a caller, Harry from Melbourne. Hello, Harry, how are you?
Hi, how are you? Question for Roger. Roger, I was fortunate enough to pull out of the equity markets in 2006, and thank God that I did, because obviously the GFC and the collapse in the stock market would have probably halved my portfolio. I'm in a fortunate position at the moment where I've got cash at bank, and obviously with low interest rates, I'm not too happy about that. My fear is the following, that if I do get into quality companies in the equity markets, what happens if there's a GFC too, and again the market collapses?
Sure. Well, what happens is the value of your portfolio goes down a lot. But the reality is that unlike that period, and I'm saying this with some confidence because prior to the GFC, 6 months prior to the GFC, I sold my funds management business. And I remember doing a presentation with Bob Gottliebson and saying to our clients at the time that you're going to wake up sometime next year and the Dow Jones will be down 1,000 points. I don't see that happening right now. There may be a 5 or 7% correction in the market. That's quite possible, but I think that's normal, and you should expect that. But see volatility as an opportunity rather than risk. The reality is right now, though, there isn't a great deal of value. We've made a lot of money recently out of internet stocks, for example, the Seeks, the car sales, the real estate .com type businesses, and we're in the process now of reappraising our holdings in those companies simply because they appear to be much more expensive. Their growth is excellent, but they're priced for perfection. So I would caution you to rush straight into the market. You need to find not only good quality businesses, but they need to be cheap as well. And right now, there doesn't seem to be a great deal of value. That's not to say the market's expensive either. I think most companies have basically reached their value. We need to see how this earnings season goes before we decide whether or not value increases and value appears again, or whether or not things have got ahead of themselves and we get a correction.
Great question. We now have Eric from Sydney who's got a question on volatility. Hello, Eric. How are you?
Yes, thanks, Mark. Look, thank God Roger's on the program. Look, what should be done? You had the graph of the volatility of shares. I have done also a graph of dividends per shares on certain stocks like ARB and the Commonwealth Bank, Coca-Cola, Woolworths, CSL, all the other stocks that I own. It's a linear type of graph with dividends per share increasing over the years. Maybe you could get a graph of ARB Corporation for the last 12 years. Get it up and we'll see the dividend thing. I would also say Harry is a victim of the great safety bubble. Thank you.
Eric, can I just comment? Eric, I don't need to see the graph of ARB. We own it. And the companies that you listed make up a brilliant portfolio of A1 businesses in Australia. So you've done very, very well. Your volatility is lower than the overall market. You've picked out of all the banks, you've picked CBA, which is the best performing bank in terms of business performance. So well done. We'll take your statement as read.
And we'd like to thank Roger's brother for calling in. That's very nice of you. And we're just here to help.
Dorothy Dixons are flying left, right, and
right. Now, can we move on?
Well, there's one more of my mates calling.
There's got to be somebody calling. Exactly. I think you're calling. What I wanted to do, Eric's got a great point. He's got a great portfolio. And that's all great. But what keeps you awake at night? We'll start with you. What keeps you awake at night in terms of the broader markets? And I don't mean drugs in sport. I mean, what is the thing that you'd be worried about?
Yeah, I'm actually pretty positive about the next 12 months, and I think I communicated this last time I was on the show. What I'm worried about is the unwinding of the imbalances that have built up over the last period, and I am concerned about much higher inflation over the next 3 to 5 years. I share Roger's concerns about the mark-to-market risks on certain securities associated with much higher interest rates. And I think we're going to have this great tension between central banks that will want to normalise interest rates, the constraints posed by currencies, because the first central bank to move will potentially put a lot of upward pressure on their currency, and trade will be affected as a result, and politicians that will be focused on the next election. The other thing I'm really worried about, which is I think quite interesting, is the global geopolitical environment. I think the recent tensions between China and Japan are just the tip of a burgeoning iceberg. I think the probability of a conflict between the US and China over the next 20 years is probably 1 in 10, 1 in 15, and that could be a complete game changer.
Absolutely. What about you? What keeps you awake?
I'm actually concerned about something quite specific. I'm concerned, and this is the only thing that keeps me awake at night. I had breakfast last year with Andrew Robb, who's the Shadow Minister for everything, including debt reduction.
And grumpiness.
Yeah, and I'm very concerned that the Liberal Party gets up and it's going to be more of the same. That's not to say I'm voting Labor or Liberal. I'm not, divulging that. But I'm very concerned that they're going to come out with a pitch where Australia needs to play to its strengths. And what are our strengths? Agriculture and resources. And the reality is those two exports aren't valued very highly globally. Right? Nobody cares about what brand of iron ore they get. And if you look at our biggest company in Australia, we've got BHP. You compare that to the biggest company in the United States. It's either Chevron or Apple. And in the case of Apple, they're producing a high value-added product. We're not doing that in Australia. We aren't producing high value-added products. What's the impact of that? The impact of that is we've got a balance of payments deficit. And we haven't got a balance of payments deficit that's permanent. The government will tell you that it's permanent, it's structural, and there's nothing we can do about it. The reason why we've got it because the value of our exports is lower than the value of our imports. We're exporting raw materials and we're importing high-added products. What we need to do is we need to incentivise manufacturing in Australia, and that isn't happening. We're not getting it. So what happens as a result? You've got a balance of payments. Sorry, just let me finish. I'm on my soapbox now.
Thank you.
But you've got a balance of payments deficit. you need in the current account, you've got a balance of payments, you need to have a surplus in your capital account. So then the government tells us that we need to have foreign investment in Australia to support our balance of payments deficit in the current account. And what do? Foreign investors buy our businesses, they buy our farms, they buy our resources, and we need that to support our spending. If we could add value to our exports, then we would be in a situation where we wouldn't be selling off the farm. And that's what keeps me awake at night, that nothing's going to change.
And I couldn't agree more. But when I look at the paper and you ask the business leaders, all they say is productivity. They're focused on productivity, and to some extent it's a question of the quality of the business leader, because when somebody says productivity, that's code for you don't have a job and you do, and you better behave or you go like him.
Yeah,
because
which I'm going to import, by the way.
That's right. And so the problem becomes business leadership directing the Liberal Party, if they need to, or directing the government. Because my concern is that in the event there's a change in government, how are they going to unwind everything they say that they'll unwind? In terms of business, productivity, but confusion. Telstra has done incredibly well on the basis of an NBN, and everyone turns around and said, that won't happen. We're not going to have an NBN, we're not going to have a carbon tax, I'm going to unwind everything. So that's a year or two into a new government, just unwinding. Yeah. I think that's business light approach.
Why would you manage a country and set policy based on what a CEO says when the CEO only cares about their tenure? You know, they're thinking about feathering their own nest.
I actually think productivity people confuse with industrial relations reform. I think
that's true. That's absolutely right.
Let me finish. Productivity. The biggest long-term driver of economic growth is productivity. But what that is really about is innovation and research and development, which is actually what you were saying, Roger. It's about adding value to the products we're producing.
I couldn't agree more. But we don't value it as a nation.
So just on the productivity thing, sorry, Mark, you can't have debt rising faster than income. You can't have income rising faster than productivity. So you need to lift productivity to lift income. And if you lift income, then you can borrow more and the credit cycle off it goes. You get growth. And that's what we need. But it isn't necessarily industrial reform. What we need is manufacturing. We need to make stuff and add value to stuff that the rest of the world wants. Yep. If we increase the value of what we export, then we won't need the foreign inflows. We'll actually go out and buy assets overseas.
But having said that, I personally think that the coalition victory, which I think is most likely on the balance of probabilities, will be tactically positive for financial market, because they'll repeal the carbon tax and the MRRT. I think long-term open question, particularly if they're committed to this austerity program.
Absolutely. We have David in Sydney who would like to talk to us about reinvesting profits. That'll be a question for you, I'm sure. David, what would you like to talk about?
Oh, hi there, team. What a fabulous panel. Look, the issue I face is that I actually stayed in the market from June last year, and I've now got a very substantial gain. It's being sort of, close to sort of 30 or 40%, and I can see the market pushing towards 5,000, and I think the time has come to probably seriously take some of that off the table. So how would the team recommend I approach that issue, and what would they recommend I do with, a significant sum of money, probably sort of, the order of 300,000 in profit over the last 6 months? I'd love to hear your answers to that. Take care, guys. Bye-bye.
Let's start.
I'm not an equities expert and I can't give you financial advice, but what I would say is obviously you can exercise that decision to sell at any time, and there's a rich range of asset classes available to you. My own personal view is that this current risk-on and positive momentum that is surrounding growth asset classes is actually going to continue for quite some time. So there may be significant, notwithstanding that we again provide cash and fixed income products, and I'm not in the business of promoting other asset classes necessarily, but I think there may be significant opportunity costs associated with being outside of that market. But then again, you've also got to think about your portfolio construction. So one of the questions I'd ask you is, if you look at your overall portfolio, what have you got allocated to housing? How much have you got in cash and bonds and other alternatives? And what's your total exposure to equities? Is that calibrated right for your risk preferences? Roger.
I actually believe that you shouldn't use price as your trigger for what to do. So the first thing, one of the things you said was that prices have gone up 30 or 40%, so now you think that you should take some money off the table. It isn't always the case that if you make 30%, it's going to go down. So don't use price as your trigger. You've got to look at valuations. Can I plug the blog, because we talk about this? There's an article on the blog. Is that right?
On.
So if you go to rogermontgomery.com, there's a little article where I talk about valuations in the Australian market. Just type in valuation into the search function, and you'll see there's a couple of articles that pop up, and I talk about this very question. But you've got to look at the value of the market, not the price. And if the market's gone up, if your assets have gone up 30 or 40%, the stocks have gone up 30 or 40%, if the value of those stocks have gone up by more, they're still cheap. So you wouldn't be selling them. So you've got to look at values.
But it's also the utility. It's also the effect of the profit. It's your behaviour as well. So I think it's going to go another 30%, but I don't really want to be in for that ride. It's a question of, I'd like to have some sleep money. So I might put, if I had 300, I might put 100 away and bank that 100 into something that I'm able to say that's a safety trade, and I might miss one-third of the movement. But at the same time, I'm okay with that sort of movement.
I think that's true, but if you don't know the value, if you don't want something, if you know what something's actually worth, you're flying blind. You're just taking a guess. And you're speculating.
So what do you do if you don't know the value?
Get it.
Sorry?
Calculate it. There's a little formula for it.
Gotcha.
Yeah.
And a lot of people are looking for new formulas, aren't they?
Look, it's a really simple one. Return on equity divided by required return multiplied by equity per share. For a business like Telstra that pays 100% of its earnings out as a dividend, that's the formula. That's the basic formula. Yeah, right. ROE divided by RR multiplied by equity per share. That'll give you an estimate.
Right, we're going to have another round 2 of the speed clock, so we will go to a break. But before we do that, with Roger for 30 seconds, you know the questions. It's cash, it's currency, it's Dow, and it's the bonds.
Okay, so...
Leading with you. 1 second. We need that 30 seconds. Don't jump early there. Now.
Okay, so in terms of cash, I actually think cash we're going to end up in a year's time basically where we are, give or take 0.5%. In terms of bonds, I think we're going to see prices fall and yields higher. In terms of the All Ordinaries Index, I think we'll see the All Ordinaries Index higher in a year's time. And what was the final asset? Was it the currency? I think the Aussie dollar could actually fall a lot if we see foreign investment start to pull back, especially from China. So I'm actually hedging the Aussie dollar and buying US dollars and Swiss francs.
Swiss francs, that's a big call.
If you love adventure, you can't beat a self-drive holiday along Explorer's Way between Adelaide and Darwin. See it all in style in a Brits four-wheel drive camper. Book now and get 40% off rental at adventurealltheway.com.au. Start your adventure now.
It's our innovation and technical excellence that sets Luxaflex window fashions apart, combining technology with stunning design to create premium awnings. Our Luxaflex Evo awnings allow you to control light and heat at the touch of a button. So now you can create a shady retreat or an additional pest-free outdoor sanctuary. Luxaflex Evo awnings are engineered to perform every time. And with such a great offer, there's never been a better time to discover why smarter design begins with us.
If you're thinking you can't do all the things you want until you knock down your credit card debt, you should be thinking ANZ. Transfer your non-ANZ credit or store card balances to an ANZ credit card and get 2.5% per annum for a full 15 months. Manage your money your way. Go to anz.com/balance transfer, call 1333 33 or visit a branch.
The all-new Honda CR-V, available in 2- or 4-wheel drive, each with a host of standard features, like one-motion fold seats, reversing camera, and clever thinking. That comes standard too.
Fortunate Frank is the luckiest traveller on earth. He doesn't need travel insurance. But you might, because when you travel, a lot of things can happen that are beyond your control. Virgin Travel Insurance provides cover from 96 cents per day, including lost luggage, cancelled flights, overseas medical and emergencies. Visit virginmoney.com.au or call 1800 034 264.
Welcome back. You've just joined us. Roger's calls and Chris's calls were fairly consistent. They thought the cash rate would be around about these levels. Currency not really moving from where we are, and of course the equity markets would rally and bond markets would be sold off. So I'm not quite sure. I'm not quite sure that we've seen the show. It's bonds versus equities. It's me versus you two. I suppose the thing that I wanted to talk about, and to put it in the context of this. I was reading Bill Gross, I mentioned it earlier, and one of the things that was very rare for him to ever do, and I was surprised about it, was he gave direct investment advice on his February outlook. And I'll just give you a sense of what his advice was. He is very concerned about the US and the credit market. He thinks that the rate of issuance of US debt is getting less bang for its buck, so the government's pushing out more and more money and there's less GDP growth. It's just not happening. So in that concern, he was concerned about inflation was number one, so he said you had to hedge against inflation. And then he said, get used to slower real growth of GDP. The QEs will have negative consequences, and so you should look for countries that have a low debt, good assets, and the first one he mentions was Australia. Yeah. So if I'm looking at the Australian currency, for example, and I talk about the idea that we're in a currency war, we, Australia, are a very small platoon in this global war, and to some extent, it's not always clear who the enemy is. Is PIMCO an enemy? Who do we define as the enemy? Because if PIMCO is saying buy Australian interest rates...
We don't know whether he's talking his own book.
No, clearly, but if he's not the only one, and when we think of Australian interest rates at 3% being very low, and as you said, 200-year lows, when you see people like PIMCO saying that's a good level to buy, you should buy Australian credit, Australian debt, that's a cause for concern in the currency and also where interest rates go.
Yeah, I think he's been positive on the Aussie bond market for actually several years. And I think people like Australia, because we've got a relatively stable political structure, and we're a good proxy for Asia, given our three or four of our biggest trading partners are China, South Korea, and India. I have a concern, as discussed in relation to the currency, that we're actually going to see higher interest rates in the North Atlantic, which are coming off a much lower base, US dollar strength, and a lower currency. But this obviously is an argument in favour of more demand for Australian debt securities.
What's supporting our currency is foreign investment.
Yep.
And if that turns backwards, then we've got a balance of payments, current account deficit, and then we'll have a huge problem on the capital account as well. But just based on that point, the countries that I've got here that have low debt, strong growth, strong trade balances, decent interest rates, it's Norway, Australia, New Zealand, Switzerland and Sweden.
So there's not a lot.
There's not a lot to
and there's a lot of money that sits on the sideline listening to people like Gross, and it's constantly coming through where you see global markets buying the Australian government debt, and everyone says, why would you buy something with a 3% or a 2.5% handle? Well, the very reason is everything else is so toxic.
Yeah, that's right.
You need to put your money somewhere. The other point that he's actually made is investing global equities with stable cash flows should provide historically lower but relatively attractive returns. That's the four majors, that's Telstra. So we see Telstra at 460 something, 62, 3, and we think that's priced in, and I couldn't agree more.
But let's not kid ourselves. In a high inflation environment, the 1970s is a classic example, the only place you could protect yourself from a loss of capital was inflation, was cash. Yeah. You still lost purchasing power in cash, but you didn't lose capital.
So that's not right. In 1990, for example, which was also the late 1980s, a relatively high inflation environment, you could get 15-16% bank deposits.
But
so cash is king.
Well, hopefully you get high inflation and massive interest rates, because if you don't, but there's nowhere to hide.
There's one place you wouldn't want to be back in 1991, which is in the banking sector, frankly. I mean, we had two of our majors. You're going to have, in that environment...
almost bought Westpac.
Yeah, that's right. You're going to have much higher arrears, big impairments, thinner margins, and these banks are leveraged 20 times plus, so that capital base can be reduced very quickly.
Look... one of the things that would come out of this conversation, I think the viewers at home should look at, is that it is quite complex, it is quite interesting, and it becomes quite risky if you don't know what you're doing. And one of the things that stood out, I was reading...
so call us, is that what you're saying?
Not yet. I'm not saying that yet. One of the things that stood out to me was I was reading one of the trade mags. Self-managed super funds have the highest growth in 5 years.
Yeah. And so in terms of inflows or in terms of asset appreciation?
No, in terms of creation.
Okay.
So there's now 488,566 at the end of 2012.
Okay, so there's a life cycle. There's a big life cycle in. So what typically happens, someone retires...
I haven't finished my question.
Oh, sorry, there's a question.
My question is this. With that evolution, that growth in those self-managed super funds, what are you concerned about for those people who were self-managed super funds start at 60, 50, whatever they're doing, and they're working as engineers, nurses, doctors, and all of a sudden turning around and saying, I want to buy an equity or I want to buy a bond. What are your concerns for this volume of people?
Well, people have become. You know, I see it mostly with doctors and dentists. You know, they spend a dozen years at university, become a specialist and become expert at what they do, and then they think, well, if I read a book on trading shares, I'm going to be an expert share trader, you know, and it doesn't work out that way. But typically what happens is somebody retires, they believe, and rightly, that no one's going to care about their money more than them, and that's absolutely right. And then they start managing their money, and some of them do very well out of it, and unfortunately some don't. But eventually what happens is they near 70 years of age, most people start saying, you know what, I want to spend more time with my kids. I realise there's no point in being rich if I'm chained to a computer, and so they hand it to experts to manage. But they spend most of their time trying to find out who those experts are.
Yeah, can I say, I think it's a great development. I think the advent of self-managed super reflects the empowerment of individuals and them wanting to take control of their financial futures. And I think that inexorably we're going to see the decline of the traditional corporate industry and retail super funds who are making decisions for superannuants in the past. I think, however, whilst you can disintermediate the big corporate super funds from the administration and the large asset allocation decisions, at the end of the day, you do, and I agree with Roger, you've got to ultimately delegate those very sophisticated decisions to professionals. But I think it's a positive development.
I think we're rapidly hitting the end of this show, so it's been a great chat. So there's in 20 seconds each, I suppose the question is, are we going to take greater risk over the course of the year? Are these 500,000 funds going to go for greater risk over the course of this year? So we'll start with you, Roger.
So, look, I actually believe that they will, and the pressure to move into equities will grow as yields fail to actually increase in the cash rate. So that'll be right. But unfortunately, the higher they push up equities that may be already overvalued, the more risk they're taking on, and the more risk of higher volatility and capital loss. So they absolutely have to be disciplined and look for good value.
My quick response would be that Glenn Stevens has basically left them with no choice with a 3% cash rate. The average self-managed super fund, I think, has a 30-40% weight to cash. So again, inevitably that's going to shift into growth asset classes. The one thing I would say is don't be too polarised or barbelled in your approach, because there is an intermediary, and we do have floating rate bonds, high yielding debt securities, and then ultimately equities, which gives you the highest probability of loss with a very high expected returns.
I am concerned about the mining sector not being able to carry the weight that everyone's got on it, and then what's the industry sector that will take over, and there's nothing really obvious to me. No. And if it's manufacturing, I could see Glenn Stevens moving the cash rate down to 2% to try and get that currency down. Now look, I'll have the last word if that's all right. Thank you very much for all your calls and emails tonight. Thank you for my special guest. It was Chris Joy, the columnist for the AFR and the director of Yellow Brick Road, and Roger Montgomery from the Montgomery Fund. It's been a pleasure. My name is Mark Todd from FIIG Securities, and that's good night from us.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
It was Mr. Frost's wish that his son and daughter receive his house, its contents, and of course his successful ice cream business. He would also like to leave the remainder of his estate to his favourite charities. Oh, your father made one last wish.
Make your last wishes something to remember. After friends and family, please include a charity in your will and help the work live on. To find out how, visit includeacharity.com.au.
Hello, I'm Tony Abbott. Your opinion counts, so my team has travelled throughout Australia listening to your concerns and your hopes. You've asked for a plan and we've consulted with the experts. The result is our plan to build a stronger 21st century Australia. Our plan will deliver 2 million more jobs over the next decade and better services for you and your family. How? By building a world-class 5-pillar economy, one that diversifies and builds on our strengths in manufacturing, agriculture, services and education, as well as mining. Our plan will deliver lower taxes and lower debt and stronger borders where the boats are stopped. With your support, we will deliver a strong, diverse economy and and a safe, secure Australia so that every Australian can get a better future.
Download your copy of our plan today at realsolutions.org.au. Authorised B. Loughnane, Liberal Party, Canberra.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
Want to know the best kept secret for amazing deals? Then visit Quibbits.com, where thousands of customers save up to 95% on products like tablets, HD TVs, cameras, appliances, and more. Imagine getting a new Apple iPad today for just $33.93.
I'm Brian, and I've won over 30 products and saved over $7,000 on Quibbits.com. The best place